Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. Ever wondered how you can secure a comfortable retirement despite the rise in cost of living? Today, I'm joined by Jonathan Scholes, who is Head of Client Wealth at Findex. Jonathan delves into the importance of early superannuation contributions and strategic retirement planning for Australians. We discuss effective investment strategies for young Australians as well, the critical role of insurance, and the benefits of maintaining a long-term investment perspective. We also talk about the value of advice and the importance of regular financial checkups and personalised retirement plans to ensure a secure and comfortable retirement for all. Well, thank you, Jonathan, for being on the show.
Thanks, Mark.
Superannuation is something, it was something I did a lot for the last 30 years, and so it's still such an important topic for me. And I'm really glad yourself and the Findex research, we can discuss this because ever since COVID and the rise in cost of living, if something's going to drop off, it's definitely your superannuation. And I understand if you're a 20 or 30-year-old and retirement's 40 years away or 30 years away, it's not going to be front of mind. But it really is important because it will be we were talking just before about, it will be their biggest asset or second biggest asset in their lifetime. So it is an important topic. So talking about the Findex research, what was really quite amazing was that 81% of Australians have changed their investment savings goals, primarily just to make ends meet, but in the last 12 months. So do you want to just give us a bit more background on that, please, Jonathan?
Yeah, so at Findex here, we decided to have a bit of a look at, what was really impacting everyday Australians out there, and the cost of living right now is very front of mind. And what we sort of saw in the research is that the way that people are investing their money and choosing to spend their money or needing to spend their money has changed a little bit, in that they're not looking at superannuation anymore as that core asset as much as maybe they were 5 or 10 years ago. And that's a little bit about the age group of the people we were talking to as well. But it does point to the fact that, where people had an option to perhaps not put money into superannuation, a lot more would take that up than what was previously the case. So it does point to that ability to make ends meet. And sometimes the choice is that you can't put extra away for retirement right now. But the conscious conversation for us is about ensuring that younger Australians do understand the impact of putting money in early is significant over the next 30 and 40 years. So it was quite an interesting report. There's certainly some data in there around how focused people were on their superannuation, how aware of it they were. And again, it's not necessarily, groundbreaking research, but it points to the fact that our understanding and our awareness of, as you put it before, what will be probably our biggest asset besides our family home, it's still quite minimal. And I do talk to clients a lot about the fact that it's your asset. And yes, you can't access it for 30 or 40 years, but it's your money. So make sure you know what it's doing, how it's performing, where it's invested. And if you can, put some more money into it early.
Yeah, and you've raised a couple of really good points there, and we'll go through each of those separately. But I saw just a report from Larry Fink, the BlackRock CEO, and he was basically saying Australia has the gold star in retirement because we do have the superannuation guarantee, but it really isn't quite enough for a lot of people. And that's why it is still so important to sort of say, okay, understanding how much is going in, and if you need to top that up or you have some spare cash, it's always going to make a huge benefit to your future self.
Yeah, I think one of the things is obviously we've had the superannuation guarantee increase quite a bit in the last few years, and it's still increasing. It's going to increase again on 1 July 2024. So it's starting to address what we know is a gap between, what people need to retire on and what they're going to accumulate. But the real advantage is if you can afford, even if it's a few $1,000s early on in your working life, the benefit of compounding over that next 30 or 40 years is going to have a very large impact. So really it is about trying to maximize contributions where you possibly can. There's always a compromise. And right now we know that many Australians are struggling to just, pay the bills and keep up with, their rent and their mortgage payments. So there's going to be moments, when you're working and when you have kids in private school where you can't But if you do get the opportunity to do it, you might get a small bonus or whatever it might be. That's the moment in time where you might go, hey, let's put in some money to superannuation with the view of it being there for the next 30 or 40 years.
And as you said, really importantly, compounding, and we've spoken about this on this podcast before, that over, compounding over a couple of years doesn't make a big difference. You're talking 10, 20, 30 years, you're looking at doubling the value of that money. Now, one of the things you're talking a bit about before, about obviously a Gen Z or a millennial is going to have a different view to retirement and super compared to a baby boomer. And one of the things I sort of saying is, okay, you may not even be able to contribute an extra contribution to your superannuation, but you can at least try and make it working harder. And we just see so many people in their 20s and 30s don't even know where their money is invested. And it really is such an important, for example, someone in their 20s or 30s may have 10 or 20% of their money in their superannuation in cash. Why does someone in their 30s need that amount of money in cash? So, getting a little bit of understanding will make such a big difference over the long term.
Yeah. And one of the things the survey showed was that, a vast majority of people don't know their superannuation balance in $1,000. Now, I'd argue, a lot of Australians wouldn't know that every single day. And frankly, I'm not sure they should, because if they're looking at it every day, then they're probably not taking that long-term view. But I think understanding, what your balance is, and most importantly, how it's invested. So if you're a younger person, your 20s or 30s, then, time is on your side, and time is your, best friend when it comes to investing. So taking risk at an early age, you can do it. You don't have to worry about what happens over the next, 3 months, 6 months, 3 years. You're worrying about the next 10, 20 or 30 years. And we know historically, the higher a proportion you have in growth assets, the higher return you'll get over time. That's not always true in every circumstance, but it's true for the majority of circumstances. So taking an active interest in how your money is invested, I think, is really important.
And you've made a good point in that, most people wouldn't know their super to $1,000, but it was the point that I really liked was you shouldn't be looking at your super every day. We're not asking you to do that, but you get your annual statement and just seeing what's happened and just taking a bit of time. So if you receive your annual statement, obviously, it's important to sort of see, what contributions have gone in, what the return is and where it's invested. What sort of the things, if you were sort of looking at as a tip and you're looking at a statement, and I know you've got a background with your own clients, what were you trying to tell people? Don't look at it every day. Look at it once, to say every 6 months or every year, but what should you be looking for?
I think there's a couple of things. The first one to me would be performance. I think it's important to look at performance. I wouldn't focus as much on the 12-month performance as I would on the 3 and 5 year numbers. I mean, you wouldn't expect that your superannuation fund will be the best performing fund every 12 months. If it is, they're obviously doing something incredibly right. So look at the 3 and the 5 year numbers. Look at the fees, and work out exactly how much you're paying, and look to see whether the fees have changed. And the third one I think is really important is looking at the insurances inside superannuation. So you had a change a few years ago where it was an opt-in rather than an opt-out type of situation on insurance, but there are many people that have insurance inside their superannuation fund that may not be aware it's in there. And look, hopefully you're reviewing that and asking the question, do you need it in there? So life insurance and disablement insurance, but also you may have gone and sought advice to get some insurance outside of superannuation. So all of a sudden you may have a double up. So the cost of insurance as you get older, premiums have gone up a lot in Australia in the last few years. So that can erode your balance quite quickly. It isn't something that's necessary, but it can also be something that can erode your balance quite quickly if you're not keeping an eye on it.
Yeah, and I think, having, it's not just someone for, if you're older, you need insurance, but as soon as you've got debt, as soon as you've got a mortgage, you should have insurance. And if you're having it under your superannuation, that cover rather than through, I know a lot of banks will say, if you're going to have a loan, you should have insurance, use our insurance, and it's usually 3 or 4 times the cost, and that's not deductible, whereas it's tax effective under your superannuation. And it really is a good point. If you are paying more for insurance, because you've increased your, if your insurance for the amount of cover you have, and you've increased it because you can also increase the amount of insurance you have, and it is actually costing a bit, it will erode that. But that's why maybe then you should be making extra contributions to cover that insurance. But at least it's tax effective compared to life insurance that's outside of super, which is just coming out of your own normal cash flow.
It is, and superannuation remains, at this point in time, the most tax-effective vehicle to save for your retirement. And okay, it's not quite as good as what it was 5 or 10 years ago, but it's certainly, still the number one place to save for your retirement. And I don't expect that will change, despite governments love to play around with superannuation. I don't expect that's going to change in that tenet of the retirement income framework in Australia. It's superannuation and it's the age pension, and superannuation needs to be the core part of that framework. Otherwise, the government responsibility to provide for the age pension for those in retirement is going to just be out of control. So I think governments are both committed to superannuation. It will always be a tax status that's better than your personal name.
Yes, and one of the other points you made earlier was when you're looking at your statement, the first thing you should look at is a performance, and really importantly, don't just look at 1 or 2 years, because you never know what's a fund. One fund could be great for that year, but it may not be any good for the next couple of years. So over a longer period, where it's 3, 5, 10 years, because 1 year is just gambling. It's just, you need to see that this fund has got a solid average, because regardless of what the share market does, and if the share market drops once every 7 to 10 years, you need a good average to see how that fund's performing. And I also think, just one other point, on that though, Jonathan, I'd love to get your view on, is that a lot of people, from my experience, will, look at the performance and say they're getting 6, 7, 8%, whatever it is, but don't actually look at the particular default fund they're in. And a lot of default funds are sort of a bit middle of the road, balanced funds and all that. Whereas if you are younger, you could actually get it working harder for you.
Yeah, it's definitely the case. I mean, without everyone's different, and understanding a person's tolerance to volatility is really important. The last thing you want to do by taking what's a risk, if markets do perform poorly over a period of time, you don't want to have the need to sell. You need to be able to ride through that. So understanding how you will behave, the GFC was a good example where your markets were down by 46% at one point in time. I'm sure you remember that, Marc.
I do, unfortunately.
At that moment, your process around understanding risk was really tested. So if you were someone who at that point in time sold, then that really hurt you for a long time. So taking a risk is great, but you've got to take that long-term view to make sure that if there is an event, and there will be a market correction at some point in your working life, you need to be able to ride through that. And you can worry about it, but don't necessarily act on it at that point in time.
Yeah, I think it's really, I used to say, sometimes sitting on your hands and doing nothing is actually the best way, because you can't time the market. Too many people have tried and it doesn't happen. But when I sort of say, yes, we do remember the GSC, but people don't remember the other 8 years that were positive after that, which on average was still doing better overall. So probably a bit more, I'd love to get a bit more of your tips or examples of where people, if they're looking at their statement, or even just getting a bit more knowledge about it, they don't have to spend a lot of time. But what some of the other things is that understanding how property and share markets work, or because that's the basis for the investment funds that are in your superannuation. What's some of the things that people, as I said, don't do it every day, but they should actually get a bit of a knowledge and understanding?
Again, it's understanding the benefit, the diversification. I think, Marc, Australia's quite a small economy, and our share market is quite small, and we do still see a lot of people that have a preference to Australian equities. So the home country bias in Australia is well and truly alive, and there's reasons for that around franking credits and dividends and those kind of things as well. But we've really seen, particularly in the last sort of 5 or 6 years, the benefits of being diversified across asset classes, be it into global shares or smaller companies or into property. There are some real benefits around having a diversified portfolio. And if you are in, an industry fund, for example, you are going to get the benefit of having some diversification. They tend to have quite a broad mix of investments inside their portfolio. And most, portfolios you will see from a financial planner will also have that same kind of diversification. So understanding to a point. So, jumping online, there's some good websites around, there's some good podcasts around too, Marc, that can talk to the reasons and some of the understanding of what is an equity, how it performs, what to look for. I think it is difficult as an individual person to go and do your own research to really form your own opinions. We all are very busy people. And for me, if my car's not working, I battle a mechanic. I don't try and fix it myself. So I think there's a message there around that is research is great, but if you are getting serious about investing, then go and have a chat with someone, even if it means just a half an hour coffee to get some guidance. I think there's some value in that. Even going to your own superannuation fund and asking them, I mean, many of them now have a limited advice service that runs through their industry funds. Pick up the phone and talk to someone for half an hour and just get some general advice on what are some tips and traps you can go through.
And that's a really important point because, you don't know what you don't know. You're not going to try and fix your own car, build your own pool. And so why with this asset that will be, biggest or second biggest asset in your lifetime, why wouldn't you get a little bit of advice? And as you say, if you can actually do it through your industry fund or advisors, it'll usually be deducted from your superannuation balance. So in the long term, you won't really notice that. So it really is worthwhile to get some professional advice because getting it set up correctly could just make such a difference to your long-term balance.
Certainly can. And there's different stages of life where different bits of advice are needed. I mean, that's the reality. We talk about life stages with clients. When they're younger clients, it's about debt management. It's about some risk insurance. It's about saving. You get to your 40s and 50s, the purpose changes. You're starting to think about, maybe paying off debt or private school fees or, going through that crunch when, your parents are maybe dependent upon you as well as your children. So there's always different life stages and, you can get help to guide you through those different stages of life, and there is some value there. I think there's genuinely some value there.
Yeah, no, a really good point. And things are different. And that's just, not a plug, but it's why I wrote the book. When you're talking about you're getting a bit older and you're looking after your children and you're looking after your elderly parents, that didn't happen last century. People are living longer, people are healthier, and we really do need to. This is why superannuation is so important, because if we're living longer, there's billions and billions are being spent on drugs and helping people be healthier and living a longer and better quality life. But we want to be able to fund it. That's the whole point. Yeah. We want to be able to enjoy this period of time.
Exactly. Well, you don't want to be worrying about money when you're 75 years of age. I mean, that's the reality. It's not a great retirement if you're constantly having to scrimp and save the whole way through. You want to be able to get to a point where you can at least maintain your standard of living you had while you were working. And that should be the goal, I think, for most people, is to have the ability to maintain your standard of living and not have it decrease. I think a lot of clients over the years have always thought they would spend less in retirement. In my experience, they tend to spend a lot more in the first 10 years of retirement.
First 10 years, yeah, I agree.
Yep. Late after that point in time. So, there's these behavioral biases we all have and these perceptions we all think are going to be there. I'll retire, I'll go to one car, we'll spend less money. Those things don't always necessarily happen. So sitting down with someone who's probably had, 10, 15 years experience of clients in similar positions, you can get some guidance around what really happens in reality.
Yeah, no, really good points. And I should actually say, we just talked briefly about at the very beginning about the impact of the economic pressures where people are under now, rising cost of living. We're seeing people with mortgage rates high. So I get that superannuation or extra contributions to superannuation would be tough. It's a really fine balancing act, isn't it?
It is. I mean, we were looking at some data the other day, and the average Australian's, mortgage has gone up over $1,000 in the last couple of years per month, and that's $12,000 after tax you have to find to pay your mortgage. Rentals are up by 15% per annum for the past 3 years. So you've got this really rising pressure, and they're necessary costs. They're not discretionary spending. They're not going out to a fancy restaurant or going on a holiday. These are things that you have to pay. So I think there are moments in everyone's life where you've just got to buckle down and do what you have to do for a period of time on the basis that at some stage you get an opportunity to do something different. And I think it's just recognizing those moments and going, okay, I'm in a good position now. Maybe I've got a pay rise, or maybe I've got a new job, or maybe there's a bit of money come through from a family member. What do you do at that point in time that can have an impact for the next 20 or 30 years, rather than, trying to necessarily thinking about today. And that's a challenge for everybody because when you're going through financial stress, if you get a windfall, well, the human brain kicks in and you want that, dopamine hit, and off you go, and you go and spend it. You go and buy yourself a, new TV, or you go on a holiday, or whatever it might be. Sometimes I just look at that point and say, challenge that and go, okay, what else could I do with this money that might set myself and my family up for the future?
Now, really good points. And even to the point that, for a lot of people, when I saw them, and I'm sure you experienced the same, they just don't know where their money is going. Okay, maybe it's not when you get the next pay rise, but what are you actually spending your money on month to month? And, in the old century when we didn't have all these little debits, you may only have 12 or 13, 15 things on a statement. Now you may have 200 things on a statement a month because you've got streaming services, you've got your Uber Eats, you've got all these other little things which you think, well, that only cost $10 or $20, but they all add up, and people just don't realize what they're spending or what they could actually find savings and all this sort of things, especially when it's a tough time, which it is right now. They could all be very beneficial.
One of the questions we ask clients when we're going through your discovery process is, what are your living needs? And then we go and do some work, and we try and use the apps that are available through the banking websites, or there's various ones out there. And what we tend to find is it tends to be 20 to 30% difference between what they think they're spending and what they are actually spending. So there's always this question, we don't know where our money is going. But once you go through the detail and you work out where it's going, all of a sudden that awareness, and that to me, I think is the importance sometimes of sitting down and having a think about it, is I don't think you can change your behavior until you understand your behavior. So, and we're not great Australians at reflecting on how we're going ourselves. I mean, the famous Australian line is, going well, thanks, when you ask someone how they're going. Yeah, I'm good. Well, what does good mean? So that's always a challenge I ask clients around is, what does that mean to you? And tell me about where your money is going. And more importantly, are you happy with where your money is going? Because it's not my job to tell you how to spend your money. It's my job to help you understand the implications of how you spend your money.
Yeah, no, excellent. I also imagine when you're talking to people, it's simple steps. It's not trying, let's just fix this all in one go. For people, and they're sort of saying, okay, well, retirement, that's 40 years away. Okay, but what can you do now for the next 5 years? Or what can you do now for the next 2 years? It must be, you just got to at least take a step.
Yeah, I mean, I think one of the best bits of advice that I give clients, I think, in terms of what can make that immediate difference, and I call it spending a day. So I take a day off work, which I know is a big thing, annual leave day or personal leave day. And I want you to grab out all your utility statements. I want you to grab out your insurance statements, your mortgage statements. I want you to grab everything and get on the phone, and I want you to call every single one of them, jump online, jump on Canstar, whatever you want to jump on, and go through all of them. And I'll almost guarantee you'll save some money during that period of time. So, how often do we just get our 12 monthly annual review through and just pay the health insurance or just pay electricity bill? Jump online, do some work, call your bank, ask for a better deal. If they say no, then perhaps call up a mortgage broker and see if you can get a better deal. Spend a day on yourself. We spend a lot of time on everyone else. We give a lot to our employers that come through. We don't often spend a lot of time thinking about our own personal position. If you take 8 hours and just spend 8 hours on yourself, I think you'll find you'll save some money.
Yeah, really. I really like that, because the research is actually, when people are under this amount of pressure, they're not taking their holidays. They're actually working more than normal. So, their actual own personal situation and getting that better is actually at its lowest point. So that's a really good tip. I like that. One of the other things, we did talk a bit about insurance, and you raised the point about that a couple of years ago, a lot of, especially if you're younger, your insurance might have dropped off. And I think probably that's something I really would like to emphasize a bit more, in that, especially as you just said, taking a day off, you might realize, well, something you're spending is you're paying for life insurance outside of super, and really having it under super, or you may already have life insurance under super, or if you don't have any insurance under super, try and get some under there, because it's just going to be so much more cost effective. I just wouldn't mind get a bit more about your views on that.
Yeah, I mean, I think we know, the statistics tell us that Australians are are very much underinsured. And I think it goes back to that point before that I mentioned around, she'll be right. It'll be fine. We have that attitude, particularly young people, where it won't happen to me. Unfortunately, during my career, I've seen it happen too many times where, where people have been impacted. There's one client that comes to mind where I saw her as a client. We recommended some insurance get set up for her. And probably 7 years later, Mark, she came back to me and she wrote me a letter saying, I kind of despised you every time that monthly premium came out of my bank account or my fund. And then she had a stroke and she was 39 with 2 younger kids. And all of a sudden now she's now a client of mine for life. We talk all the time. She's become a good friend of mine. But she didn't think she needed the insurance. Whereas for me, she had a disabled daughter. She had another daughter as well. So there was some reasons for her to have that cover. So I think sometimes it's one of those things you don't want to spend money on, and hopefully you never actually use it. So no one wants to use life insurance or income protection insurance, but if the worst case scenario does happen, then you're covered. So, plan for the worst and hope for the best. Now, superannuation is a very cost-effective way to have life insurance and some disability insurance as well. It's not great for income protection anymore. But it is still good for the life insurance in particular, and it is definitely cheaper than owning in your personal name.
Yeah, and I think the role of the professional advisor in a person's life, because people say, I can't afford a financial advisor, or I can't get advice. We're just briefly talking about that before. You don't know what you don't know, and it's over and over again. We see successful people. The Richard Bransons of the world, the Bill Gates, they all have coaches. They all have advice. Even the best tennis player in the world still has a coach. It's not, why do we not think that we don't need, or we can do this all by ourselves? And we're so busy, we very rarely ever get time to do it. So having a professional advisor or getting a coach must make such a difference to your life. And that's a perfect example.
Yeah, and there's more and more opportunities for people to get, limited general advice now. And I know, obviously the cost of advice is an issue, and it remains an issue. And while the government's trying to make some changes there, they probably haven't got there just yet, Mark. So that challenge is there for government, but also for firms like Findex. And we're really looking to embrace how we try and service those clients that might not need us for every day for the next 10 years, but might need us on a one-off occasion. So. And I think there are some good things coming down the pipeline around legislative change that will allow, more limited advice to be given to clients that hopefully won't be as expensive as what it currently is.
Yeah, anything they can do to make it more affordable for the average Australian is just got to be a good thing.
Sure.
Now, one of the things I know Findex did as part of this research was sort of project the future of Australian financial health. Is it good news? Is it bad news? What did Findex come up with?
I think one of the things we looked at in particular was what the focus of today is versus tomorrow. And I think the short term for Australians, it is focused on the now and trying to make sure they get through. I think for us, we know that Australians probably overestimate how much they need in retirement to have a comfortable retirement. So one of the stats was they believed that they needed $1 million inside superannuation to have a comfortable retirement. That's a bit higher than what all the AFSA surveys, state. $1 million would be fantastic, and this $1 million number, it sounds great. It's this, it's this round number that goes through. But it is a matter of looking at it and saying you might not need $1 million. And I think the numbers are at the moment around $600,000 for a single person in retirement to have a comfortable standard of living as defined by AFSA. Now, that retirement standard, it's not all beer and Skittles, Mark. It can be a little bit tough, but it does give you the ability, that combined with the other pillar of the Australian retirement income framework is the age pension. So if you can build up enough superannuation that you've got some flexibility in how you spend your money, and you can also have access to pension, then it does change the narrative a little bit. And you mentioned before around the time frame that someone is retired for now. So whereas, 30, 40 years ago, people weren't living to age 90 as often as they currently are. So I call it stretching out, your retirement income. So, trying to make sure that, for example, working through to 65 and then having this retirement date, maybe working through to 67 or 68 on a part-time basis, what that does, the longevity of your capital, it stretches it out by so much. Just those few extra years where you're not drawing down everything you need, or accessing a pension. I mean, it's a big deal, but it does stretch out your capital a lot. So I think Australians are in a good place for retirement. I think the superannuation changes around the guarantee going up have helped. I think some of the rules around the ability to put money in out of your own pocket and claim a tax deduction have been beneficial as well. But it is still that challenge for Australians, I think, to spend just a little bit of time, focusing on that superannuation to make sure they give themselves the best opportunity to succeed.
Yeah, and I think having that longevity and the things are just different now. People do need, and that's another reason I think people just do need to get advice, even as you said, just as one off. And you're thinking, well, okay, I may not be planning to retire. I'm enjoying working, but what does option A, option B, option C look like, and project it out? Because exactly, if you just say, and I had people come in to say, I know I need $1 million. I said, well, how much do you actually need to live on? It's not $1 million. It's different for every particular person. And as you said, you may be working part-time, whatever it is, all these sort of things. And just trying to do it as a guess is just not for your retirement. You get one chance to retire properly. You need to do this, get some proper advice.
There is some good, basic calculators online. You can go and have a look at how much you need. I mean, I think there's some real power in some bespoke modeling for you, and that's certainly something that a planner should do as part of the advice process. And what you tend to find is once you can show a person that they're going to be okay, it tends to relieve them so significantly. And you mentioned before around it's such a long time away retirement that sometimes it's hard to focus on it. When you put something in front of someone that says, hey, if you do X, Y, and Z, you're going to get to this point at that point in your life. And I'm sure you've seen it before. You can see their shoulders drop.
Yeah.
All of a sudden, they do become more relaxed. So, and that's what I think a good planner will do. It will allow a client to walk out of that room with a feeling of comfort. And that's, I think, our primary job, our primary role.
And just, we've been talking a lot about Gen Z and millennials and cost of living, all that. But actually, on the flip side, the people who are retired, the baby boomers, so few of them are getting advice. And for anyone who's listening there, that I just saw a ridiculous stat the other day that say there's about 3 million people who are over 65, only about 40% of them have actually switched over to a tax-free status in retirement and their superannuation. They're still paying the 15% tax on their balance and or whatever they withdraw. That's just crazy.
It is. And we see it a lot. I mean, we're lucky enough to see quite a number of new clients, and I don't think there's been a client yet that we can't help to some regard. So, it is pretty rare. I mean, I think people are getting better again, and everyone's trying to educate. I mean, the reason these podcasts exist, like we're in today, is trying to educate people on those kind of things. People are getting better, but it's still one of those ones where there's a fear. And, I talk a lot about the fear of getting advice or the fear of looking into your own position. And sometimes I think it's about, I'm not sure how I'm going. I might be a bit embarrassed. I'm not sure I've got enough. Just go and ask the question. You're much better to go and ask the question rather than to be sitting back fearful around whether you have enough or not. So, but that tax-free piece, I mean, there's very few ways in Australia to have a lump of money that doesn't have any tax levied on it. In fact, there's no other way other than your family home and superannuation. So use it.
Yeah, absolutely. And when 1.4 million people still haven't done it, you sort of think in retirement, you sort of think, it should be something the government nearly says, if you're retiring, you need to go speak to someone. You wouldn't. It's just crazy that people are paying tax when they don't need to. Okay, Jonathan, appreciate all your time here. One of the last questions we always ask our guests is, what's, say, the best piece of advice you've ever heard or had that you've seen? And you've given some great pieces today already to our listeners, but what's something you've heard?
Yeah, I mentioned before that, taking a day, I think that's a really big one. And I'd encourage anyone who listen to this podcast to do that. I think you'll find it really beneficial. I think for me, I was very lucky enough to have a very strong mentor from early days. And he says something to me, which I think has stuck with me, in that it's never too late to start, but it's never too early to start as well. So I think no matter where you are in your financial journey, I think it's the best time to start is today. So don't necessarily sit on your hands and go, well, I'm 55. It's too late for me. I can't make a difference. I remember vividly a client coming in to see me at 58, and he was not in a good financial position. And he had his retirement goal in his mind of fishing and playing golf. That was his retirement. All he wanted to do was go fishing and play golf. And I remember saying to him, we can get you there, but the next 7 years is going to be hard. You're going to have to make some sacrifices. We put in place a plan and he stuck to it. And the day after he retired, I went and played golf with him. Now, he was a terrible golfer, by the way, but his retirement at that point in time to him was all about those two things. It wasn't necessarily about this financial number. It was about giving him enough money to be able to do the things he wanted to do. And that, I think, is what retirement is. I think when you're talking to a client, you need to start thinking about retirement as what it looks like for you, what money allows you to do, not necessarily thinking about dollar amount. So, so anyone listening to this podcast, think about what you want your retirement to look like and be like, and then work backwards from there around, okay, how much money do I need to give myself to be able to do that?
Yeah, great piece of advice. Thank you for that. And, I'm seeing a lot of people, exactly as you said, in their 50s. There's a lot of people, women who are getting divorced and basically starting again. But if you've got a goal and you, as you said, 7-10 years and you really do work, put money away, it's amazing what you can achieve in a short period of time. So great piece of advice. Jonathan, really appreciate your time on the podcast today. And there's lots of tips, lots of strategies there, but it really is. It's an important asset and we also need to do a bit better on that. So again, thank you for being on the podcast today.
Thanks, Marc. A pleasure.
I hope you enjoyed this episode. If you'd like to know more about Jonathan Scholes and Findex, visit www.findex.com.au. You can also find their latest research on superannuation retirement on their website. Or feel free to email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Visit my website, themoneysandwich.com, for free templates, online calculators, and subscribe to our newsletter to help you now for a better retirement tomorrow. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.